When we look at the world's financial system, it's easy to imagine that there are a handful of powerful individuals or secret organizations pulling the strings behind the scenes. Tales of hidden cabals and clandestine meetings have long captivated our imaginations. But the reality of how global finance is controlled is both more transparent and, in some ways, more complex. To understand who really controls the global financial system, we need to examine the institutions, networks, and mechanisms that make the modern economy function. At its core, the global financial system is a vast network of interconnected banks, investment firms, central banks, regulatory bodies, and multinational organizations. These entities operate across national borders, facilitating the movement of capital, setting standards, and influencing economic policy worldwide. While no single person or institution holds absolute power, there are key players whose decisions and policies can have profound ripple effects across the globe. Let's begin with the central banks. These are the institutions that manage a country's money supply and monetary policy. Among them, a few stand out for their outsized influence. The United States Federal Reserve, known simply as the Fed, is perhaps the most powerful central bank in the world. Its decisions on interest rates, quantitative easing, and financial regulation directly affect not just the American economy, but global markets as well. When the Fed raises or lowers rates, currencies fluctuate, stock markets react, and borrowing costs change worldwide. Similarly, the European Central Bank, ECB, holds immense sway over the Eurozone, impacting the economies of 20 European countries. The Bank of England, Bank of Japan, and the People's Bank of China are also significant players. Each of these institutions is technically independent, but their leaders often act in tandem, particularly during times of crisis, to maintain global financial stability. They communicate regularly, sometimes even coordinating policy moves to prevent economic turmoil from spiraling out of control. But central banks are not the only actors. The International Monetary Fund, IMF, and the World Bank are two supranational organizations that play critical roles in the global financial system. The IMF, headquartered in Washington, D.C., was established after World War II to promote international monetary cooperation, secure financial stability, and facilitate international trade. When countries face balance of payment crises or currency collapses, the IMF steps in, offering emergency loans, often with strings attached. These structural adjustment programs have sparked controversy, as they typically require countries to implement economic reforms that can be politically and socially disruptive. The World Bank, meanwhile, focuses on long-term development, lending money to governments for infrastructure projects, education, and poverty alleviation. Both institutions are governed by member countries, but voting power is weighted according to financial contributions. As a result, the United States, Japan, and major European economies exert significant influence over their decisions. In addition to supranational bodies, there are powerful regulatory groups and standard-setting organizations that shape the rules of global finance. The Bank for International Settlements, BIS, based in Basel, Switzerland, is sometimes called the Central Bank for Central Banks. It serves as a forum for cooperation among monetary authorities, and its committees set important standards for banking supervision and capital adequacy. The Basel Accords, developed by BIS committees, determine how much capital banks must hold in reserve to guard against financial shocks. Private financial institutions also wield enormous power. The largest investment banks, J.P. Morgan Chase, Goldman Sachs, Morgan Stanley, Barclays, Deutsche Bank, and others, are at the center of global capital flows. They underwrite bonds, facilitate mergers, trade currencies, and provide financial advice to governments and corporations alike. Their size and interconnectedness make them systemically important, meaning their failure could threaten the stability of the entire system. Asset management firms, such as BlackRock, Vanguard, and State Street, have become influential in their own right. Collectively, these firms manage tens of trillions of dollars in assets. Through their investments in stocks, bonds, and real estate, they own significant stakes in companies across every industry and continent. Their voting power at shareholder meetings gives them a say in corporate governance, executive pay, and business strategy. In recent years, these asset managers have faced pressure to use their influence to promote environmental, social, and governance (ESG) standards. The structure of ownership in the global financial system is another important factor. Studies have shown that a relatively small group of institutional investors and banks control large portions of the world's assets. In 2011, a group of Swiss researchers analyzed the relationships among 43,000 transnational corporations and found that a core of just 147 firms controlled nearly 40% of the network's wealth. While this does not mean these firms act as a single coordinated entity, it demonstrates the concentration of financial power in the hands of a few. Governments and policymakers remain critical actors. National treasuries, finance ministries, and regulatory agencies set the laws and policies that govern financial markets. The U.S. Treasury, for example, has broad authority to impose economic sanctions, regulate foreign investment, and supervise the banking sector. In times of crisis, governments can intervene directly, as they did during the 2008 financial meltdown, by bailing out major banks and injecting liquidity into the system. In addition to formal institutions, informal networks and forums play a significant role. The Group of 7, G7, and Group of 20, G20, are gatherings of the world's largest economies, where finance ministers and central bank governors discuss global economic issues and coordinate responses to crises. The World Economic Forum in Davos, Switzerland, brings together business leaders, policymakers, and academics to debate the future of the global economy. While these forums have no formal policymaking power, they help shape consensus and establish the boundaries of acceptable policy. Financial markets themselves are both arenas and agents of power. The collective actions of millions of investors, traders, and algorithms determine the prices of currencies, stocks, and commodities. Sentiment can shift rapidly, moving billions of dollars in seconds. When markets panic, as they did during the 2008 crisis or the COVID-19 pandemic, they can force governments and central banks to act quickly and decisively. The rise of technology has introduced new actors and dynamics. High-frequency trading firms, cryptocurrency exchanges, and fintech startups are challenging the dominance of traditional financial institutions. Bitcoin and other digital currencies, while still relatively small compared to the mainstream system, have sparked debates about the future of money and the potential for decentralized finance. So who really controls the global financial system? The answer is not a secret society or a single mastermind, but rather a shifting constellation of institutions, networks, and rules. Power is diffuse, yet concentrated, transparent in some ways, opaque in others. At the heart of this system is trust. People, businesses, and governments must trust that money will hold its value, that contracts will be honored, and that the rules of the game will not change arbitrarily. When trust breaks down, as it did during the 2008 crisis, the consequences are felt worldwide. Critics argue that the current system is too concentrated, giving too much power to a handful of countries, institutions, and individuals. The dominance of the US dollar as the world's reserve currency, for example, gives the United States unique leverage over global finance. When the Fed acts, the world listens. Efforts to diversify away from the dollar, such as China's push to internationalize the renminbi, have made progress but have not fundamentally altered the landscape. Others point to the influence of private financial institutions and asset managers, questioning whether their actions always serve the public good. The too big to fail problem remains unresolved, and moral hazard persists when banks and investors take risks knowing they may be bailed out in a crisis. Calls for reform are frequent. Proposals include strengthening international regulation, increasing transparency, giving greater voice to developing countries and institutions like the IMF and World Bank, and addressing the social and environmental impacts of financial decisions. Technological innovation, such as blockchain and decentralized finance, holds promise but also poses risks of its own. Ultimately, the control of the global financial system is not a static condition, but a dynamic process. It is shaped by negotiation, competition, cooperation, and sometimes conflict among a diverse set of actors. While some have more power than others, none are omnipotent. The system evolves in response to economic shifts, political changes, technological advances, and the demands of people around the world. Understanding who controls global finance requires us to look beyond simple explanations and appreciate the complexity of the system. It means recognizing the roles of institutions, markets, governments, and individuals, and remaining vigilant about the risks and opportunities that lie ahead. As the world becomes more interconnected, The need for effective, fair, and resilient financial governance will only grow. Whether that governance comes from reforming existing institutions, embracing new technologies, or finding new ways to cooperate across borders, the future of global finance will be shaped by the choices we make today. In the end, the question is not just who controls the system, but how that control is exercised and for whose benefit.